Puts Unveiled, exploring option strategies unleashed. A put option is a contract giving the option buyer the right, but not the obligation, to sell or sell short a specified amount of an underlying security at a predetermined price within a specified time frame. This predetermined price at which the buyer of the put option can sell the underlying security is called the strike price. In this video, we will be unveiling the secrets of puts and strategies. So before we get started, make sure to hit that like button. Also subscribe to my channel. 1. Bearish puts. Bearish puts are powerful tools utilized by traders to take advantage of downward movements in the price of an underlying asset, such as stocks, commodities, or indices. They are designed to generate profits when the market experiences a decline or enters a bearish phase. When traders anticipate that the price of an asset will decrease, they can purchase bearish put options. These options give them the right, but not the obligation, to sell the underlying asset at a predetermined price, strike price, within a specific time frame, expiration date. The price of the underlying asset declines, the value of bearish put options tends to increase. This is because the right to sell the asset at a higher strike price becomes more valuable as the market price falls further below the strike price. 2. Volatility puts. Volatility puts are an effective hedging tool used by traders to safeguard their portfolios against sudden and significant changes in market volatility. These options contracts are specifically designed to provide protection and mitigate the risks associated with unpredictable price swings and market turbulence. Volatility puts serve as a form of insurance against the adverse effects of market volatility. They allow traders to hedge their positions and protect their portfolios from unexpected and large-scale price movements. When market volatility increases, stock prices tend to fluctuate rapidly and unpredictably. Volatility puts enable traders to lock in a specific selling price, strike price, for the underlying asset, even if its market price experiences extreme volatility. 3. Ratio puts. Ratio puts are a sophisticated option strategy that allows traders to potentially amplify their profit potential in the event of a significant decline in the price of an underlying asset. By employing an uneven ratio of long puts to short puts, traders can take advantage of favorable market conditions while managing their risk exposure. Ratio puts involve buying a different number of long put options compared to short put options. The ratio can be adjusted based on the trader's outlook and risk tolerance. This asymmetrical setup allows for the potential amplification of profits if the underlying asset's price experiences a substantial decline. 4. Calendar puts. Calendar puts, also known as horizontal spreads or time spreads, are option strategies that capitalize on time decay or the erosion of an option's value as it approaches expiration. This strategy involves purchasing a long-term put option while simultaneously selling a shorter-term put option with the same strike price. The primary objective of a calendar put strategy is to profit from the different rates of time decay between long-term and short-term put options. Short-term options tend to lose value at a faster rate as they approach expiration compared to long-term options. In a calendar put, both the long-term and short-term put options have the same strike price. This means that the trader expects the underlying asset's price to decline moderately or stay relatively stable in the short term, while anticipating a more significant decline over the long term. 5. Diagonal puts. Diagonal puts are a strategic options trading approach that combines elements of both calendar puts and bearish puts. This unique strategy involves purchasing longer-term put options with a lower strike price while simultaneously selling shorter-term put options with a higher strike price. By blending time decay and a bearish outlook, diagonal puts allow traders to potentially benefit from both factors. Similar to calendar puts, diagonal puts capitalize on time decay. The shorter-term put options sold at a faster rate of time decay compared to the longer-term put options purchased. This difference in time decay rates creates a potential profit opportunity. Diagonal puts are implemented with a bearish bias, indicating the trader's expectation of a decline in the underlying asset's price. By purchasing longer-term puts with a lower strike price, Traders position themselves to profit if the asset's price falls significantly. 6. Protective index puts. Protective index puts are a powerful tool that traders use to safeguard their portfolios against market-wide declines. These options function similarly to protective puts, but instead of being based on individual stocks, they are tied to market indices. Protective index puts provide broad protection to traders by aligning with the performance of market indices, such as the S&P 500, Dow Jones Industrial Average, or NASDAQ. They serve as a hedge against market-wide declines, helping to offset potential losses in the overall portfolio. By utilizing protective index puts, traders can protect their portfolios from systemic risks that affect the broader market. These risks may include economic downturns, geopolitical events, or unexpected market shocks that can lead to widespread declines in stock prices. 7. Synthetic puts. Synthetic puts are a versatile options trading strategy that allows traders to replicate the benefits of owning a put option by combining long positions in the underlying asset with long positions in put options. This synthetic strategy offers downside protection while potentially reducing upfront costs. The primary objective of synthetic puts is to replicate the protective characteristics of a traditional put option. By combining long positions in the underlying asset with long positions in put options, traders aim to gain downside protection in their portfolio. In a synthetic put, traders initiate a long position in the underlying asset. This can be achieved by purchasing the stock outright or using alternative methods such as buying call options or utilizing other derivative instruments. 8. Vertical puts. Vertical puts, also referred to as bear put spreads, are an options trading strategy designed to manage risk within a specific price range. This strategy involves two key components: buying a put option with a lower strike price and simultaneously selling a put option with a higher strike price. The primary objective of vertical puts is to manage risk by limiting potential losses within a defined price range. This strategy offers a more controlled risk profile compared to simply buying a put option outright. Traders initiate the strategy by purchasing a put option with a lower strike price. This put option gives them the right, but not the obligation, to sell the underlying asset at the specified strike price within a specific time frame. 9. Leaps puts for long-term protection. Leaps puts, which stand for long-term equity anticipation securities puts, are a valuable tool for investors seeking long-term protection against potential downside risks. These options have extended expiration dates, typically ranging from several months to a few years, allowing investors to hedge their portfolios over an extended period. Leaps puts differ from standard put options by offering extended expiration dates. While traditional put options typically have expiration dates within a few months, Leaps puts can have expiration dates ranging from several months to a few years into the future. 10. Protective married puts. Protective married puts are an options trading strategy used by investors who already own the underlying asset and want to protect their position against potential losses. This strategy combines ownership of the asset with the purchase of put options to create a protective buffer. The protective married put strategy begins with investors owning the underlying asset, such as stocks or ETFs. They have a long position in the asset, believing in its potential upside. To protect their ownership and limit potential losses, investors simultaneously purchase put options. These put options give them the right, but not the obligation, to sell the underlying asset at a specified price, strike price, within a specific time frame. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.